Hey, everybody. Good morning. We may have a light crew this morning only because I know everybody is hustling to get to Bold. For those that don't know, Bold is at Believing Church. So just make sure that you're aware of that. So you put the right address in your GPS. I want to make sure everybody gets there on time. I will be there coming in right at 9, which is when obviously we'll get started. But today we're talking about seller seconds. I want to show y'all a video because this is a creative financing call, right? We're still doing shift and we're talking about creative financing. We talked about seller seconds on the last call, but I want to chunk this down. I think this video is a really good one for us to listen to. So if y'all can hold on just a minute, let me get over here to this guy. Hopefully y'all can hear this.
I told you there's a way for sellers to help buyers with the down payment and potentially make money doing it. Yep, it's possible. With the right setup, a seller can actually provide down payment assistance in the form of a second mortgage, and it can be a win-win for both sides. So today I'm breaking down how a seller's second mortgage works, the rules that apply, and why this little known option could help move more inventory and make more deals work that otherwise wouldn't. Let's get into it. A seller's second mortgage is exactly what it sounds like. The seller agrees to lend the buyer part or all of the down payment. That loan sits behind the main mortgage as a second lien. The buyer makes regular payments on both loans. This is not a gift. It's a real loan with real terms, but it can help buyers with limited cash while helping sellers close the deal. Fannie Mae and Freddie Mac allow this type of structure, but only if the loan meets certain guidelines. Here's what's required for seller-held seconds to be legit. The loan must have a market rate of interest, so no sweetheart deals. So no balloon payments within the first 5 years either. No negative amortization where the balance can actually grow over time. It can't be forgivable. This is a real loan, not a hidden discount. So no prepayment penalties or restrictions if the buyer wants to pay it off early either. And the buyer must fully qualify for both the first and the seller-held second mortgage. The key takeaway here is that this isn't a loophole. It's a legitimate financing tool when used the right way. What makes this strategy a game changer for the right buyer? Low down payments. So buyers can purchase with as little as 5% down, eliminate PMI. So with 95% loan to value and a seller second, you might avoid private mortgage insurance entirely. Lower monthly payments. Structuring the financing this way can make the home more affordable. And then potential tax savings. So buyers may be able to deduct the interest from both mortgages. This could help buyers who don't qualify for traditional down payment assistance, but still need a little help to make the numbers work. Sellers benefit too, big time. So income potential, that second mortgage earns interest, creating a passive income stream. It moves inventory. So more buyers can afford your listing when the financing is flexible. Negotiating power. You might not have to drop the price, just structure the deal differently. It's still a sale though. So you get most of your money from the buyer's first mortgage. So it's a creative solution for sellers with equity who want to help buyers and close faster. Let's say a buyer has good credit, solid income, but they're short on cash for the down payment. The seller offers a second mortgage for 10% of the purchase price. The buyer brings 5% down, and the first mortgage covers the remaining 85%. So now, instead of walking away from the deal, everyone wins. The buyer gets the home, the seller moves the property and creates an income stream. There's no private mortgage insurance, so there's lower monthly cost and potentially better terms. So it's a powerful option that's underused simply because most people don't know it's possible. So if you're working with a seller with equity and flexibility, a buyer who needs down payment help, a property that's been sitting on the market, this might be the perfect solution. So talk with the seller about their willingness to carry a second mortgage, connect with a lender who understands seller seconds, and then get the proper loan terms documented upfront. This is still a real mortgage. Want to know if a seller second is right for your deal? Book a call with me today. I'll walk you through how it works, review the...
All right. I thought that was a really simplistic way of explaining seller seconds. And I also have Miss Patricia on the call to talk to us about what that looks like from the lending side, and where the gaps are, what we should look for if we're even, considering this.
Okay.
Ms. Patricia, are you on the call?
I am here. Thank you so much. Good morning, everyone. So I do want to just kind of that's a great video and all that is valid. So, but I do want to kind of give you guys some heads up on how it relates to from a lender's perspective. So the way he explained it, that means you have a first and you have a second mortgage, subordinate financing, something like that. So that means you have a first mortgage with the lender, and then you have a second, with the seller financing. So one thing you have to do is you have to check with your preferred lender to make sure that, for one, that you can do this. And number two, you have to check to make sure what is called the combined loan to value. That's one thing that all lenders have to adhere to. There's a matrix set that matrix basically indicates, let me the matrix basically indicate like what the requirement is for loan to value, your ratio, things like that. So this is one of the things you have to look into, and it's CLTV, combined loan to value. Combined loan to value is basically includes all the loans of the property, meaning the first mortgage and the seller second, divided by the property value. Okay. So most times the lender has maybe a 95%, in some cases, 97% combined loan to value, just kind of depends. So my thing with that is in short, just make sure you check with your lenders, because we have although he said, I know Fannie and Freddie allow these things, lenders most times have what we call overlays. Overlays are, okay, yes, Fannie say we can do this, but this lender says, hey, we're capped out at this. So just making sure that that lender is actually able to do these things. Okay. And keep in mind, the lender, which is when you're actually doing the loan, the lender, they actually set the guidelines. So they are set in first lien position. So they set the rules. Everything else has to come or adhere to those rules as it relates to secondary financing. Does that make sense?
Yes. So,
So
I mean, so
it's
if,
the
oh, go
Go ahead.
ahead.
I'm sorry. It is a good strategy, a way to do, but just ensure, just checking with your lender, confirming what the max combined loan to value is for that particular product or program.
So, your question is what because I'm going to put that on the sheet. What'd you say?
Okay.
What's the question? Ask the lender what the combined loan to value is
Yes, what's the combined loan to value, or CLTV?
on
Because
that property.
loans have a loan to value. The loan to value is just the amount that the amount that the bank is financing versus what the house is worth, or the sales price. Well, the combined loan to value is all the loans, the first mortgage and the second, divided by the what the house is worth. Now, back in the day, way back in the day, we used to do like an 80% first and then a 20% second, so that person can avoid the MI and, still do 100% loan. So they've kind of pulled away from that a little bit. And because when you're exceeding the combined loan to value, that means then that we'll be financing more than what the house is worth. So lenders has put a stipulation on the combined loan to value amount. That's why you don't see, anything pretty much over 95% combined loan to value.
So, if you're working with a buyer,
Mm-hmm.
you obviously need to call the lender to see if this is an option. And with the
Yes.
right lender, like Patricia's saying, we'll walk them through the process of all their options and also explore this. If you're working
Mhm.
with a seller and we're going to say, hey, we're offering creative financing, and here's the things that we're offering. If we're going to offer seller seconds, we also need to call the lender
Mhm.
to ensure that the combined loan to value on that property will meet those requirements.
Mhm. Right.
So all that to say is I'm going to put this all in a one sheet because we have talked so far about seller financing, contract for a deed, seller seconds, temporary buy downs, permanent buy downs, and y'all, we are going pretty deep into this creative financing thing because what we're saying for sellers and for buyers is we have a toolkit of options, right? And so
Right.
whether that option is a fit or not, obviously is something that they've got to talk to their local lender or whoever their preferred lender is to gain additional information. But this is where, Patricia, I know you would agree with me. This is where y'all need to get on the phone with your buyer and your preferred lending partner and
Yes.
listen to the lender explain it to the buyer, right? Because then y'all get to learn. Like we're not loan officers or mortgage professionals. However, we need to understand the flow of money. And this is a financial conversation and an options conversation that y'all need to understand just so that you can create options for your people. The goal is to unlock the red tape on both sides to get more people to purchase property in our cities and our towns. I hear people talk about this all the time. Specifically in Memphis, everybody's so angry about these out of town investors. And the problem is we're locally not teaching people how to buy the inventory that we currently have.
Right.
So if the investors are financially savvy, then we've got to teach our people and we have to be financially savvy. So that's where all of these things, I know that this is not the most entertaining conversation when we talk finance and loans and terms, but this is where negotiation happens, where optionality happens, and where the differentiator comes in for y'all as professionals. So we're going to keep chunking this down a little bit. I'm going to create a one sheet, just like I've done for contract for a deed and seller financing, that will say, hey, if your buyer needs this and your seller has this, and we might have a potential marriage there with this seller second, then here's some additional questions. And these are the people you need to bring to the table to see if that is an option.
Hey, and Sarah, one other thing, I'm actually just speaking from, the lending side of it, but I will do some more digging to see, what else is out there. Because, loan officers, we talk all the time or what have you. So I'll check and see what else is out there as well. And so when you do send your information out, I'll have some more, information for you as well.
I love it. I mean, y'all,
Mhm.
I don't know. A lot of us follow bigger pockets. I mean, these are high level, bigger pocket style investor conversations. And I want us to understand that not just investors have access to optionality. The consumer has access to optionality, but if they don't understand what their options are, they feel like there's no options and then they don't want to move forward. Right. So anyway, all good stuff. I am going to head over to Bold. If y'all need anything, please let us know. We'll be on the call tomorrow. Chucking down some other. I think I'm going to look at potentially final offer tomorrow. So I'll let y'all know what I can cover with that, and we'll hit on that tomorrow. So lots of good things coming up, and then obviously after coming back from family reunion, I'll have a whole slew of stuff to go over with y'all. So exciting stuff. Thank y'all for going on the journey. Let me know if you need anything. Make it a good one. Make it count. Bye, everybody.